This ain't advice. I'm not your advisor. And as they say in the biz, slap that subscribe button. We're only about 100,000 away from a million. We're almost there. Welcome to a special Buck Talk Corona Crash explainer episode. And today's Saturday. It's Leap Day. It's February 29th. And I'm going to be talking about what's happened so far, what we can think about going forward, and where this kind of fits in the context of things, just my kind of general thoughts on the market movements, and how to think about this. Obviously, I don't know anything about what's going to happen in the future. I'm just looking to give a little context for what's already happened, looking backwards. So where are we at? The S&P 500 is down about 13% from its highs. And the kind of scary thing is it happened so fast. It was just 6 or 7 market days ago when they were at very highs. So that's kind of the jarring thing. We've had such a smooth market for so long. Really the only big downturn, I'll get back to this in a second, that we've had maybe back to 2016 was in the fourth quarter of 2018. We had a little pullback. So the S&P 500 biggest companies in the U.S. are down about 13%. The Dow Jones is down, I think, just a smidgen more than that. And then looking at a couple other stock areas, so the Russell 2000, which is smaller U.S. stocks, is down about 13.5%, so down a little bit more than the S&P. And foreign stocks, their high was a little bit longer ago, but they've been down about 11.5% off their highs. They're actually not faring as poorly as the U.S. market, which is sort of interesting. So I just mentioned fourth quarter of 2018, and obviously it's a longer time period, 3 whole months, but it was recent, it was sort of similar. You should probably remember it. The S&P 500 was down 19.8%, and there's a magic threshold of 20%. I'm kidding, it's not really magic, where you call it a bear market. You hit downturn to 20%, you hit 10%, you call it a correction. So we're in a correction. We had a correction back then, and there's no rhyme or reason for why they're there. There's round numbers. You have, on average, a pullback of more than 10% almost once a year, if you look at the stock market historically. So being down 10% happens about once a year. I saw a list, I think, 2018, 2016, and then I think every year, 2008, 2009, 2010, 2011, all had pullbacks, and then even more frequent before that. It's been kind of weird that we've had so many years without them going back recently, including, I think, 2017, we didn't even have a down month. I think I'm getting that right. And so people forget that stock markets can go down for no reason whatsoever. There does not need to be a reason, and that's important. There will always be a headline reason. There will always be things going on. And CNBC or whoever is telling you what's happening, there's news organizations, they have to tell you why it moved. They can't just say, oh, it moved and we don't know why. So they're always going to say, it's called a post hoc ergo propter hoc, I think is what it's called, where it says after this, then this. So one thing happened first, and then another thing happened after, and they say, therefore, the first thing caused this. And that's not always true. We don't always know why the stock market moved. In this case, we have a pretty good feel for it. Coronavirus has been moving around. It's shutting down supply chains. I've also seen some arguments, and I'm sort of sympathetic to them, that Bernie Sanders doing very well in the primary and better than expected would move the market down. I think that's a reasonable line of reasoning. I think it's hard to know on any given day whether something like that would be the same magnitude as something like new news on the coronavirus. But it is worth noting there were coronavirus headlines for weeks before the U.S. stock market started going down. And they were saying, oh, market goes up, market goes down based on this. And it was really only when we got those 6 straight days of downhill markets that everyone said, oh, this is definitely it. But they were using it as sort of scapegoat, whatever the market did. If the market went up, They'd say, oh, allayed fears. We're not worried about it anymore. So getting back to coronavirus specifically, coronavirus is what's called a negative supply shock. So it is something that is external, and you might call it a exogenous supply shock, where basically something happened that's generally out of the market's control. It doesn't have anything to do with the market itself. Sort of like a war, where resources are either getting used up, depleted, or are going somewhere else. So if you have a war and a country is spending a bunch of money on missiles, we're not creating anything productive. Sure, a couple companies might make money off the deal, but you're not really making a more productive society. Similarly, if you, and this is called sometimes the broken windows fallacy. So if you, and it's a fallacy when you talk about it, is if you're boosting GDP by breaking a window. So in theory, if I break the window that's right next to me and I have to go get it replaced, then I'm giving money to the window maker, I'm giving money to the guy that installs it, they're going and spending that money, and GDP will be higher than if I hadn't broken the window. But that doesn't do anyone any good, because I still have the same amount of windows as I had before I broke the window, and I can't buy something else or invest in other things because this window was broken. So I'm certainly poorer, and the world is very slightly poorer because something was just broken, just wasted. So wars are similar, and epidemics are similar. Pandemics are similar. So all these resources, all these interruptions, they're just going to make everybody worse off. So I'd say, first of all, there doesn't need to be a bounce back in the stock market once this goes away. Now, there probably will be some sort of correction in one direction or the other, because let's say the market's down, we'll call it 12% right now. There's no way of knowing if really, when it's all said and done, the coronavirus will have done something that eliminated the value of 12% of these companies. But it certainly will have reduced it somewhat. So right now, you can think about it like the market is thinking that the most likely, or the average, or there's a whole bunch of different nuances that you should at least be open to thinking about, but simply put, most likely it would be 12% of the value of the companies is lost. They were disrupted, all the earnings, it was reduced, it's going to take them longer to get back on track to where they would have been, and that's not going to be the right number. It's not going to be exactly 12%. Now, if this ends up being really, really bad, maybe it's a much greater number. If it ends up not being so bad, at least economically, not so disruptive, then maybe very little value is lost. That seems hard to believe at this stage. 5 or 10% seems pretty reasonable. But even when it's all over, there's not a reason that I see to expect stocks to just, snap back to where they were. So that's one thing. And then we have to think about, okay, what are the future other possible outcomes? So on the one hand, you could say, well, I don't think the market is properly factoring in the likelihood that this is really bad. In which case, you'd say, okay, it's probably going to get worse. You could also say, well, I think the market's probably got it pretty well, and maybe there's a sort of distribution of possible results. And maybe that means that 50% of the time, 12% is going to be exactly where it should be. The market's going to kind of level off here, and then it'll kind of chug back along at its normal rate, which of course is very volatile going forward. You might say, okay, well, what about the other 50%? Well, maybe, and I'm just making something up. Obviously, this isn't exactly how it works, but maybe there's a 25% chance that it's much worse, and the market keeps going down. It goes down another 12%. We end up down 24 or 25%. Or maybe there's another 25% chance that actually it's not that bad. It gets contained, or we get a vaccine right away, and very few people die. Maybe it ends up killing fewer people than the regular flu killed this year when all is said and done. I think that's still possible. I think the numbers are still lower than the flu. And then probably there is a little bit of a bounce back because there is some bad news that should be priced in, should be expected. So when we're thinking about the future, we want to think about where are we now and what's already priced in. We don't know what kind of damage this disruption is going to do to economies. And take a little left-hand turn. I've heard a couple questions about, the Fed is looking like it's going to lower interest rates. And I've heard some people criticize that. That's absolutely crazy. Is exactly what the Fed's for, is external supply shocks. That is, lowering interest rates is exactly what you do here. That's why interest rates were raised in the first place, so there'd be room to cut them when you need to cut them. That is, the people that are saying that the Fed shouldn't be cutting rates because of the flu, they're crazy. They don't understand the purpose of the Fed. But we'll have lower interest rates. The Fed will try to do what they can to ease monetary policy, to keep the economy growing, positive growth, whether it's real growth. Maybe there'll be, despite the rate cuts, perhaps there will be negative growth or very low growth. But try to keep the growth on track, and then seeing how the companies do, seeing how the economies do, that's going to be the real question. Nobody knows. And very few people were even alive during any pandemics like the size this could be if the worst happens. And so the economy is totally different. The world's so interconnected. Even if we had some experience with other pandemics of similar scope to what people say the worst case could be, it's hard to know exactly what it would look like. I can do most of my job from my house. I can hook up my laptop to some monitors and handle it. And you can just do video chats instead of face-to-face meetings for a few weeks. And maybe a lot of the world can do that. Maybe a lot of the world can't. How's that going to play out? What are our mortality rates going to look like in more advanced countries? Or maybe if there's a bigger exposure event, there aren't enough hospitals to treat people. Those are all possibilities. Those are all things to think about. But nobody knows. And in general, when nobody knows, it's a reasonable position to say, I think the market is making a reasonable estimate right now. If you feel differently, you can always make a move, and maybe just a little bit one way or another, but say, I think they're underestimating the odds that this is going to get worse. And maybe you decide, okay, that means I'm going to wait before I make my Roth contribution for the year. Or you say, hey, I think actually this is a good opportunity to buy. Even though you don't necessarily expect a quick snapback because the damage has happened. It's real damage. It's not like when the market just goes down for no reason, often it snaps right back. Something of value has been lost. We just don't know how much. The disruption kills value, destroys value. And so you might say, well, then why would I invest if that had already happened? Well, for the same reason you invest at any point, where you want the returns of the market, and now is usually a better time than later to invest. And of course it feels unsafe, but there's lots of really good graphs that show all of the scary things on the calendar that have happened, and some of them move the market, but in general, if you look up and to the right, that's where the market's going. And there's always a really good, really smart reason not to be invested. And this is just the latest one. Now, who knows how long it'll last? Who knows how long this flu will last? If it'll be around with us forever, if it'll go away after one season or 2 seasons, or it won't go away until we get a vaccine. And that could mean that the market's depressed until it gets resolved. But nobody knows that. There have been lots of things recently where people thought the market was going to hate it, like when I don't think we bombed Iran, but we killed one of the Iranian leaders in Iraq. And people said, this is it. There's going to be a war. The market's going to go way down. And that was true for about a day. And it kept going on its merry way. And if you had invested at that time, well, you would have been investing about the same levels you invested now. And that's kind of the other thing. People forget the markets have had such a good run. The prices today are the prices in October of 2019. So we're back 4 months. Basically no difference. We're still so close to all-time highs. Obviously, we're 12 or 13% off them, but we just hit all those highs. In October, those were the highs. So people that are freaking out about, oh, we're off so much, it doesn't worry me that much. It's true, it's the quickest 10% decline from a high ever, but there have been days that have moved 10%. They weren't right at the high. So 1987, for instance, a bunch of days had elapsed since the high was hit, but there was a single day where they were down more than 10%. So it's not like 10% moves can't happen quickly. They do happen quickly. It's true, this is the fastest it's happened from the time the high was hit, but I mean, the fastest thing has to happen at some point, and it just happens to be right now. That record will probably get broken sometime in our lifetimes. We'll probably have a high and then a snapback off some news, but it doesn't seem to me like a big deal. I think if you've got a plan, I would just stick to it. That's what I'm doing. That's what I'm thinking about. So I hope this was helpful, at least thinking about it the way that I'm thinking about it, and of course, express your views on the market with your money, however you want to.